In this lesson, we're going to talk about developing your trading playbook. We're going to get into the rationale behind why it's important to have a number of setups or systems in your playbook, as well as some ideas in terms of the plays you're going to want to incorporate into that playbook. So first off, where do many traders go wrong? If you take a look at this little picture on the right hand side of the screen, you'll see a little hand with a lighter trying to boil an ocean. And unfortunately, this is what a lot of traders try to do. They go for this big bang approach where they try to do everything with one single system. And I like to call it the all-in-one approach, where they try to capture every single wiggle and market opportunity using one single trading system or setup. And this, of course, is impossible, right? So, unfortunately, though, as you try to build out a system like that tries to seize every single opportunity, what usually transpires is that you create a system that is pretty much undefined. There's a lot of gray areas as you're trying to capture too many different variables and opportunities. And what this really results in is a combination of perhaps several systems, indicators, and strategies all mashed and blended together. So it's very difficult to see the beginning and end of the system, as there is no beginning and end, as there are no defined starting points and ending points. So what I see a lot of traders end up doing is that they put so much work into building this kind of all-in-one system that when things begin to break down, there's no easy way to troubleshoot that system. It's difficult to understand where in the system that there's a breakdown in terms of performance. And trying to troubleshoot and upkeep a system like that turns into a very laborious, intensive process and ends up just creating a deeper and deeper hole for the trader. This approach never works, because ultimately, if you try to build a system that captures everything, you actually you spread yourself too thin. Just like in the design world, where they always say, if you try to design to everybody, you end up designing for nobody. And so it is with trade setups and trade systems. We want to be very specific about the type of opportunity we're trying to capture with that particular play. We want to have that intention ahead of time, because we're not trying to create a system or setup for every single wiggle, right? We really want to be, again, intentional and targeted in our application of our systems and or setups. So this all goes back to the premise that we need to begin and end our thinking around the business. And that means diversification. Not diversifying simply your portfolio, we're talking about diversifying your setups. Now think about a large company like Apple. Now Apple sells a lot of products. Of course, their biggest seller is the iPhone. But there's a reason why Apple has a diversified portfolio of products they can sell. Certainly, they can make a lot of money selling just iPhones. But Steve Jobs and company knew very well that they can make even more money by having a diverse ecosystem of products. And likewise, in our trading business, we want to be thinking of the exact same approach. How can we diversify, in this case, our setups, because we don't have products or services here? How can we diversify our setups so that we can capture the most amount of profits? Sure, you could probably have a successful business with one single product. But there'll be times and there'll be cycles where that setup may not be very effective. So what do you do in those situations or scenarios? Do you just sit on your hands and wait until the cycles become more conducive? Yes, that's certainly a valid and legitimate strategy. But if you actually had more setups in your playbook, then you'd actually have more times at bat. The other really big reason in terms of diversifying our setups is that it allows us to better control the risk. Again, it always goes back to risk management first. If we find that one of our setups or plays, and I'm using again those terms interchangeably, if we notice that the efficiency or efficacy of that setup isn't up to par, then we can begin to reduce our position sizes around that setup, or perhaps stop investing in that setup completely. Just like a business that sells physical products, right? If we notice that, let's say for instance, that no one's buying our mobile phones, then we probably want to begin producing less of them. We don't want to fill the shelves full of mobile phones that no one's buying. Now, on the flip side, if we find that our setups are, one particular setup is making a lot of money and it's raking it in, then it's our job as a trader to increase our size responsibly in that setup. Every dog has his or her day, right? And when things are working, when the cycle that we're trading in is conducive for that particular strategy or setup, then we really need to be adding size and really putting the pedal to the metal on that particular setup. That's our job as traders. Just like a business. If the mobile phones are rushing off the shelves and they're hot and in fashion, then we really want to be stocking the shelves as much as we can with that product so that we can maximize the profitability of that particular product. The key to this is starting small. I see a lot of traders try to do too much in the beginning, and even if you've been trading for a while, it's easy to get tempted to try to go quickly when you learn a new setup. But what works best is to build methodically on a system and slowly begin to add size. We're going to get into this concept later of adding size and graduating to larger positions, but that's the idea, is that we want to graduate to those larger positions. And how we're going to do this responsibly is by tracking metrics. Tracking metrics both around the system and the trader who trades that system. So, all your standard metrics, win-loss rates, average win versus loss, your average risk to reward, the average return on that particular setup, the largest drawdown, losing streaks. And in terms of the trader, we want to be seeing how compliant that trader is to that particular system. For instance, if you have a system with a high win-loss rate and even a high average return, but you have a trader who's unable to actually comply and take the signals of that system, then that's a problem. So a lot of this has to also do with whether you, the trader, can actually follow the system. Let's give an example. Let's say, for instance, you have a system that gives you 4 or 5, let's say 4 signals a week, but the signals happen at 4 in the morning. Every time the signal occurs, it's usually profitable and it usually makes money. But because it happens at 4 in the morning, you're only able to take 1 out of 4 of those signals. In this case, your compliance ratio is only 25%. So what may have been a profitable signal that had a high percentage of probability now becomes a net loser because the trader is unable to comply with that signal. So the net is we want to be tracking both the efficacy of the system but also the trader. We need to be tracking those 2 metrics so we can understand if and when a breakdown occurs, where that breakdown's happening, so that we can better, again, allocate our resources around either the development or the monitoring of those 2 things. Okay? Because if we want, if we want to be investing in our business, then we need to understand what to invest in. If the systems are an all go and a green light, then we need to be investing in those systems. But if the trader is breaking down and is not in compliance or acting in a manner that's consistent with a good trader, then we need to pull back our investment in that trader until that trader is able to develop the skills necessary to earn the right to trade. Now, before we move on to talking about the actual plays that we want in our playbook, let's give a little bit of context. So first off, trying to create plays or systems outside of the actual broader market context is a fool's game, right? Everything has to be looked at in terms of the broader context. And so the decision-making process as it pertains to picking the plays we're going to apply to our trades really follows the following 3 steps. Number 1, first off is understanding the broader market environment. If you're a longer term trader, this may mean doing some inter-instrument analysis and seeing how maybe the broader market is trading against maybe various currency pairs or various commodities and bonds and so on and so forth. If you're more of an intraday trader, maybe this means simply looking at the higher time frames and seeing the broader trend for the market. Once you see that broader market context, then comes the step of picking the trade from our playbook, or picking the setup from our playbook. This is the step of trade selection. Then lastly, we have the methodology in place, or the trade management in place, to manage the risk and to do the trade management. Okay, so all of these things have to happen in that order. Number 1, understanding the market context. Number 2, then we can pick our play from our playbook. And then number 3, we can then manage that as per our methodology. And so why this is so important is because oftentimes traders can get tripped up in terms of trying to time the market or trying to be correct. And in the game of trading and in the world of simply dealing with uncertainty, the game isn't to try to be right. The game is trying to make the right decisions based upon what we know at the time. So again, although we want to reduce uncertainty by following this process and allows us to do so, we're not trying to be right. We're simply trying to trade in the direction of the broader context of the market so that we have the most probability on our sides. Because if we're wrong, that simply means that the scenario that we thought we were trading in was incorrect. And that simply means that another scenario is now, there is now a higher probability for another scenario to unfold. And that just means, again, we go back into our decision loop of market environment, trade selection, and trade management. So let's talk about the plays that you should consider for your playbook. So there are a number of them here. Let's go through some of them. Consolidation plays and range plays. These are plays that we would consider plays that you'd play in when the market's either channeling or kind of choppy. Uptrend, downtrend plays. So what are you going to do if a market is trending upwards or downwards? For instance, you might want to buy on a pullback if it's a strong uptrend, or short into strength on a weak stock or weak trend. Think about support and resistance plays. So if you have strong levels of support and resistance, how are you going to play that? If you see a large seller putting up a large print at resistance, do you have any plays to take advantage of that? If you see a buyer stepping in and buying large size at support, do you have any plays to take advantage of that scenario? If all of a sudden some news comes out, what patterns or setups can you think about to try to capture that change in the market dynamic? If you see the market do something like a dead cat bounce and starts to bounce off of some strong levels, how can you capture that move? The opening range for intraday traders is a very, very profitable time of day, as you have a lot of volatility, and there's a lot of options there, from opening range breakouts to breakdowns to simply trying to go for gappers and goes. Stocks trading through important levels, filling the gap plays. So if you see a stock or a market instrument gap up, do you have any tools in your arsenal to allow you to perhaps play for that gap fill. And finally, parabolic moves. Instruments that are stocks that move explosively in a parabolic fashion. Consider setups that will allow you to take advantage of those moves by going long those setups or going in that direction, or selling those parabolic moves. Now, that's a lot to think about, a lot to consider, but to boil it down, you can really summarize all those setups in 3 broad categories. Number 1, there are breakouts or momentum plays. Number 2, there are pullback plays. That means you're buying or selling at a discount. So when the market either comes back and you want to go long, you'd buy it on a discount. Or the opposite would be true if you want to sell. You'd be selling when the market, you'd be shorting when the market goes, when the market has some strength, looking for a continuation to the downside. And then having mean reversion plays, meaning when the market gets overextended either to the upside or downside, or stock gets overextended, we'd be looking for that stock or market instrument to revert back to the median. So having at least one set of plays defined in each one of these broad buckets, I think is very important to have in your playbook. And this will allow you to diversify your portfolio of setups and your playbook. So all of this, again, is in service of doing 2 things. Number 1, risk management. We've spoken about it already in this lesson, the importance of risk management and how having numerous plays or setups allows you to better manage risk, right? We're not investing or putting all our eggs in one basket. It'll smooth out the linearity or our P&L curve, as we're not trying to do everything with one single setup. And secondly, it removes uncertainty from our plan. Because what we're trying to do ultimately with these different plays and setups is that we're trying to apply them based on market context, like we said earlier. And it again fits in this idea that as we're trading, our job as a trader is to do 2 things, right? Number 1, manage risk. That is, we want to trade, we want to never put ourselves in a position where one single or series of losses will take us out of the game. So number 1 is risk management. And number 2 is staying in the game by being able to remove uncertainty so that we can stay ahead of price action. The only way to make money in the game of trading, and if you want to be a great trader, is to stay ahead of price action. And the only way you can do that is by having certainty about what you're going to do if a certain scenario unfolds. We can never control the markets. Neither should we try to be right, as I mentioned before. Our goal, once again, is simply control what we control, and that is our actions. And how we do that is by applying these following principles. Number 1, having a broad expectation or understanding of the expectation of the market participants. If we, before we get into the actual trade, can have an understanding of what the market expects, that is, the participants who are trading that instrument expect, then we can have an understanding of what to do in case that expectation fails. So let's say, for instance, you have a stock that gaps up at the open and starts to move up. Perhaps the market participants who are trading that stock expect that stock to continue higher. So, with that understanding in mind, you can begin to anticipate various scenarios. What would happen if that stock fails to go higher? Right? What are you going to do if the stock fails to go higher? How you manage a position if you're in it, if you're already in that trade. Most market participants, if they're in that trade, are only expecting it to go higher. They're not thinking about possible other scenarios unfolding, which is why most traders end up getting burnt when these types of stocks inevitably go down because they don't think about possible scenarios that could occur. We want to be thinking about not just what could happen with the stock, but what are we going to do if the stock fails to continue to make new highs and higher lows? How are we going to adapt? So, if we're in a long and we get stopped out based upon the stock failing to go higher, then what are our alternatives? All right, how are we going to adapt? Are we just going to sit at our hands? Or does this scenario that has now failed, has it created a new scenario which we can take advantage of? So, if we were in that stock that was a gap and go play, the stock has now broken down, is now shooting to the downside. What setups do you have in your playbook to take advantage of that scenario? Do you have any mean reversion setups now? Especially if this stock had gone parabolic. Do you have any methods in your playbook which can capture some of that downside? So these are the principles: expectation, anticipation, adaptation. This will keep you ahead of price action. Otherwise, all you're doing, if you're only trading the setups, then you're thinking like the crowd. And like a fire in a theater, when the crowd panics, everyone rushes to the exits at the same time. Our goal as traders is to stay ahead of price action. And the only way you can do that is to begin to create the scenarios so that you can adapt your actions and stay ahead of the curve. So, in summary, let's talk about why it's important to have a playbook of setups and what to do about it. The first step, define your trading systems. We've spoken about this in the past. We want to have very defined and targeted trading systems or setups. Not ones that try to do everything and try to capture every single market opportunity, but systems that apply and that focus on particular market conditions. Number 2, diversify your systems. We want to have more than one system so we can maximize our profitability. Number 3, focus on one system at a time. Right? Find the systems that have an edge and then begin to accumulate the metrics on both the system itself and whether you, the trader, can actually trade that system. Number 4, as you're learning the systems and as you're back testing them and accumulating the metrics, that's your time to actually practice your execution. So take it seriously. Number 5, your job as a trader is to get bigger in your A+ systems or setups. That means when they're banking coin, it's your job to add size. And number 6, think like a professional. That means get ahead of price action by using the principles we just talked about of understanding expectation, that is the theory of mind of the participants who are trading that particular instrument, anticipate other scenarios that could unfold, and then lastly, how are you going to adapt? Which of your setups or systems can you pick from your playbook that can take advantage of the new scenario?